You don't lose money in trading because you're bad at analysis. You lose because you're optimizing the wrong thing. You were taught to chase accuracy, to be right, to predict, and that instinct, right there, is mathematically useless. In fact, it's the reason most traders never escape break-even. Here's the uncomfortable truth. The market does not pay for being right. It pays for expectancy. And once you see this, you'll never look at a losing streak, a win rate, or a strategy the same way again. Why doing everything right still fails? If you're watching this, chances are you've said at least one of these. I followed my setup perfectly, and it's still lost. My win rate is high, but my account isn't growing. I don't understand why price keeps moving against me. That frustration isn't random. It comes from believing trading is about prediction, when it's actually about probability. Markets are not designed to reward intelligence, effort, or confidence. They reward one thing only: positive expectancy executed repeatedly. Everything else is noise. And today, we're going to dismantle the biggest illusion retail traders fall into and replace it with the only edge that actually matters. The math you can't ignore. 1. Being right is emotionally addictive and financially irrelevant. Retail traders are obsessed with one metric: win rate. How often does this strategy win? What percentage of trades am I right? That obsession feels logical. In real life, being right equals success. In school, at work, in arguments. But markets don't work on social logic. They work on payoff distributions. Let's strip this down. A trade has two variables that matter: clarification how often you win, how you win relative to how much you lose. That relationship has a name: expectancy. Expectancy answers one question: if I repeat this behavior hundreds of times, do I make or lose money on average? Not on one trade, not on today, on the process. And here's the formula that quietly runs your entire trading career. Expectancy equals win rate times average win minus loss rate times average loss. This isn't theory. This is arithmetic. Ignore it, and the market will charge you tuition. 2. Why losing more trades can make you more money. Now here's where things get uncomfortable. You can be wrong most of the time and still make serious money. Let's say you take 10 trades. You lose 7 of them. That feels horrible. Your confidence gets hit. Your psychology starts wobbling. But what if the 3 winners are each 15 times larger than your losses? 7 losses times 1 unit equals -7. 3 wins times 15 units equals +45. Net result? +38 units. You were wrong 70% of the time, and you crushed it. Now flip the scenario. You win 7 trades, lose 3, but your wins are tiny and your losses are large. 7 wins times 1 unit equals +7. 3 losses times 10 units equals -30. Net result? -23 units. High accuracy, negative expectancy. This is the betrayal. Your brain celebrates the wrong outcome. The market doesn't care how often you feel smart. It cares how the math resolves over time. Stop and think. If being right was the edge, then prediction contests would create millionaires. They don't. Trading pays those who structure asymmetry, not certainty. 3. The psychological damage of chasing win rate. Here's something nobody explains clearly. When you chase a high win rate, you force yourself into bad behavior. Think about it. To keep winning often, you must take profits early, void volatility, lulled losers longer than planned, wrongly does to accept being wrong quickly. That's not discipline. That's fear disguised as strategy. And it leads to the most common retail pattern. Small wins, small wins, small wins, one massive loss. Account damaged, confidence destroyed. Not because the trader was reckless, but because the strategy demanded it. This is why so many traders feel profitable right before they blow up. The math was negative the entire time. 4. The safe strategy trap nobody warns you about. Let's talk about strategies that feel safe, consistent, smooth, high win rate. They generate dopamine. You feel in control. But here's the problem. These strategies often have capped upside and unlimited downside. You're collecting small rewards while standing in front of a steamroller. It doesn't hit often, but when it does, months of gains disappear in days, sometimes hours. That's not bad luck. That's negative convexity. The wins are defined, the losses are not, and expectancy doesn't forgive that imbalance. High win rate strategies with rare, massive losses often look amazing until probability catches up. And probability always catches up. Why? This isn't just theory. Professional traders don't obsess over single trades. They think in distributions. They know any one trade is statistically meaningless. Short streaks prove nothing. Randomness dominates small samples. That's why discipline alone never saved anyone. You can be perfectly disciplined and still bleed slowly with a negative expectancy. Control without edge just delays failure. Edge is the engine. Discipline is the seatbelt. Confuse the two, and you crash responsibly. How to think like the market. Here's a simple framework to cut through confusion. Step 1. Define risk first. Before you think about entries, targets, or indicators, define how much you lose when you're wrong. If that number is unclear, stop. No defined loss equals no expectancy. Step 2. Measure payoff, not feelings. After a sample of trades, ask average win size, average loss size, win frequency. Then calculate expectancy. No stories, no excuses, just math. Step 3. Think in batches, not trades. One trade doesn't matter. 10 trades don't matter. Expectancy reveals itself over large samples. This is where most traders quit too early or double down too emotionally. Step 4. Align psychology with math. If your strategy has positive expectancy but low win rate, you must expect losses. Losses aren't failure. They're participation fees. If your emotions can't tolerate that, your strategy and your psychology are mismatched. Where traders go wrong. Let's clean up the biggest mistakes tied to expectancy. Trap 1. Abandoning a strategy too early. A short losing streak does not invalidate a system. Probability clusters. Losses come in waves. Without a large sample, you're reacting to noise. Fix. Commit to sample size, not emotion. Trap 2. Increasing size after wins. Winning streaks feel like confirmation. They're often randomness. Increasing size during statistical noise is how traders magnify drawdowns. Fix. Scale based on data, not confidence. Trap 3. Confusing discipline with edge. Following rules doesn't mean the rules work. A losing strategy followed perfectly still loses. Fix. Verify expectancy before optimizing behavior. Trap 4. Seeking certainty in an uncertain game. Indicators, news, predictions, all attempts to feel safe. Markets don't reward certainty. They reward asymmetric risk. Fix. Replace prediction with probability. Trap 5. Letting psychology take the blame. Most traders blame emotions when the real problem is math. If expectancy is negative, no mindset will save you. Fix the math, then train the mind. 1000 Trade Reality Check. Here's a truth that humbles everyone. You cannot judge your skill from 20 trades, or 50, or even 100. Randomness dominates small samples. Even a strong strategy can look broken early on. Statistically, it takes hundreds, often around 1,000 trades for results to stabilize around true expectancy. That's not discouraging, that's clarifying. It means surveyed confidence is dangerous. Early despair is premature. Consistency beats intensity. The market tests patience more than intelligence. Let's compress everything. You don't need to be right. You need to be paid more when you are. Win rate is a distraction. Feelings are irrelevant. Single trades mean nothing. Expectancy is the only edge that matters. Build it, measure it, protect it with discipline. And once you do, price moving against you won't feel personal anymore. It'll just be math, doing exactly what it's supposed to do. Question for you. What's harder for you right now? Accepting losses or trusting the math long enough for expectancy to work? Answer honestly. That answer tells you where your real work is.